Hello, good evening, everyone. Okay, just a quick one before we start. So I just want to check if everybody can hear my voice. Okay. Okay, so just let me know if you guys can hear my voice clearly before I start. Okay. Okay, seems like yes. Okay, good. So if everyone can hear me, then just let me do a quick introduction about myself. So my name is William, and I'm a dealer and also a marketing staff at Phillip Futures, and I'm from Kuching branch. So tonight I will be the speaker on the topics: have U.S. indexes actually bottoms out? Because I think this is one of a very big question for a lot of people that are actually trading the US market or that are trading the US indexes market, because the news are flying around saying that the economy might enter into a recession, or the war is not over yet between the Ukraine and Russia, and all kind of things are happening. The U curve is inverting. The short-term U curve is going up really aggressively. There are all the noises in the market. So I think this is a very big question for everyone that are trading the US market. So before I move into the topics tonight, I just want to do a very quick introduction about our company's Phillip Futures. Yeah, just in case some of you are new to our company and are not familiar with us. Okay. So just a quick disclaimer before I move on. Whatever that I share tonight is only for knowledge sharing purpose and is not a buy and sell call. Okay, so if you want some personal advice or something, you can definitely contact one of us. We have branches all over Malaysia. Or if you want to, after I share my point of view, if you have questions, you want to talk to me personally, you can also contact me. Okay, so about our company, Phillip Futures. So we were incorporated in October 1995. So we have been in the market for quite a long time in the futures industry. And our headquarters is actually based in KL, near to somewhere at KLCC. Okay, we are a subsidiaries of Phillip Capital Holdings, and our mother company, Phillip Capital, is actually from Singapore. So we are actually a Singaporean company, and we have branches all over the place. Okay, in Kuching, in Cebu, in KK, JB, KL, Malacca, Penang. So you should be able to find us whichever that is convenient for you. Okay. Other than that, Phillip Futures, we are a trading and also a clearing participants of Bursa Malaysia Derivative Berhad. So with that, we have this license called the CMSL license, which allows us to operate the financial business, such as derivative business, such as futures trading, the contract for different CFD trading in Malaysia legally. So we are a legal broker house recognized by the Security Commission and Bursa Malaysia. So about our company, why we have been famous in the market all this while is because one of the reasons is because we are the first broker in Malaysia that actually provide an online trading platform for both local and foreign products. So everything is under one roof. So if you want to trade foreign or local products, you don't need to have two different platforms, two different login to trade. You can just log in one single platform and do everything under one roof, which is also one of the reasons why we are the top choice among a lot of professional traders in Malaysia. So if you are one of our clients and you are listening to this, just want to say a very big thank you to you. Without you, we won't be able to achieve this. So in 2020, we actually got 3 major awards as a first runner okay, being the best overall derivative, the best retail trading participant, and also the best institutional trading participant in Malaysia. Is recognized by Bursa Malaysia. Okay, so our mother company, Phillip Capital, we actually have offices over 14 different countries. So we have a very wide network, and we don't only offer products in Malaysia. We do offer different products from the US under different exchange in the Europe, in Japan, in Hong Kong, or even in Singapore. Okay, we have products all over the world. So I believe that whatever that you are looking, the commodities market, the indexes market, you should be able to find it with us. Okay, so just a quick run through about the products categories that we offer. So the first one will be the interest rate futures. What is interest rate futures? Is something like we have been talking about the treasury yield. So if you want to trade the treasury yield market, we do offer it under the interest rate categories. So tonight I will be sharing a lot about US indexes. We will look into the history, we will look into the future of the US indexes. So that is under the index futures. And recently, we have been talking about crude oil, one of the spotlight in the market that is under the energy futures, and also the agricultural. One of the major is the edible oil market has been going really crazy about edible oil market. Everyone has been talking about it. Even people who don't look at the market knows that the edible oil prices has went up tremendously. Okay, that is under the agricultural futures. And lastly will be the metal, which is like gold, silver, etc. Okay, so other than futures, our company also offer contract for difference. In short form, we call them CFD. Okay, so in under the CFD category, if you want to trade US market, US stocks, Bursa stocks, you can trade them at very, very attractive margin, 10 to 20%. Most of our margin is about 10 to 20%. And the prices that you trade is basically similar to the real exchange prices. We don't market make our prices. So you will be trading exactly the same price as per the exchange. Okay. Other than that, we also have these US indexes CFD. So US indexes CFD, you can trade the US market indexes with a very good leverage as well. Okay. So why trade with us? First of all, we offer the latest market news for our clients. Okay. Exclusively for our clients. We have 24-hour support. So if you have problems in the midnight trading the market, you can call in. Someone will be able to help you. And if you want some advice personally, you can contact us. We will be able to advise you based on the very wide range of product that we offer. Okay. So if you want one-to-one coaching session, contact us. We do organize one-to-one coaching session exclusively for beginners, and also free seminars or webinars all the time. Okay. Something like tonight, you can just register them from our website. So if you want to open an account with us, it's free of charge. Okay. You are not paying anything. You just need to fund in at a minimum of 1,000 to activate it. And we have this online account opening. We are the only broker house in Malaysia that have online account opening for futures. So if you want to open an account, you can just scan this QR code, you fill up the form, then you will be able to open an account. Okay. Also, just a quick one, just to show you our platform. For futures trading, we are using Phillip Nova. So in Phillip Nova, we have over 90 different indicators. You can directly buy or sell from the chart. And you can trade, like I said, you can trade everything under one roof. Okay. And if you want to try a demo, you can scan this QR code and you will be able to look how our platforms actually look like. It's a demo account. So for CFD, we have Phillip CFD Trader. It's very user-friendly. Okay, we have live chart inside as well. So this is basically how it looks like, the interface. So yeah, that is basically all about the platform that we use. So let's move into the main topic tonight. So have US indexes bottom out? Okay, so these are the 4 things that we are going to discuss tonight. The first one being, in case some of you are new to the market, just a quick introduction about the differences between the S&P 500 index, the Dow Jones, and also the Nasdaq. The second will be, what is the current economic cycle on US indexes? And the third one will be, what are the things that I look at to monitor the development of the Ukraine and Russia tension, and also how does it actually reflect in the US indexes. And the last one will be, have US indexes bottom out? Okay, just a quick one to run through between the differences. Okay, so first is we call them the Nasdaq. Okay, so Nasdaq is more on the technology. It consists of 100 big capital tech stocks in the US. And the second one is the S&P 500. So S&P is more of a balance index. It consists of technology and also the industrial and financial. So it's very balanced. It's not affected by single sectors as much as Nasdaq or Dow Jones. Okay, it consists of 500 big caps company. And the last one will be the Dow Jones index. So Dow Jones is more heavy on industrial and it's more heavy on financial. So it consists of only 30 big cap. So if you want to trade something more balanced, definitely looking into the S&P 500. Okay, if you are a very technology person, then look at the Nasdaq. Okay, so what is inside the Nasdaq? So if you look at the top 10 component stocks, right, they are all technologies, and just purely looking at Apple, Microsoft, and Amazon, they are about like 30% of the component index. So if you can get the direction of just these three stocks, you basically is able to catch the direction of the Nasdaq. So just by monitoring these three stocks, give you a direction as well, okay, of the Nasdaq. Now, second, we look at the S&P. So these are the top 10 component stocks under the S&P 500 index. As you can see, it's very balanced between technology and also the financials, or even some of the healthcare is a very balanced index. So it's not over heavyweight under single companies, okay, unlike the Nasdaq. So the last one will be Dow Jones. So Dow Jones, there are only 30 stocks, and these are the top 10. Okay, as you can see, the United Health, Healthcare, the Home Depot, the Goldman Sachs, they basically almost dominate over about 20%, over 20%. So it's very heavy on the financials, the industrial, the healthcare sector. Okay, so these are the top 10 of Dow Jones. So now let's look at the 4 economic cycles. Okay, I think this is something very interesting for us to look at. First of all, okay, if we want to know how US market is going to perform moving forward, first of all, we need to look into the history. Okay, we need to look into the history on how US market perform under each economic cycle. Different economic cycle have different implication on the US indexes. So the first economic cycle, we call them the bond tapering cycle. Okay, these are the bond tapering cycle. So basically, US started its bond tapering program back in 2014 and end the whole bond tapering thing in October 2014. So it took US, the Federal Reserve, 10 months to end the quantitative easing. Okay, so what is bond tapering? Bond tapering is exactly what we are experiencing back in November 2021. You have been hearing that US is saying that, okay, they are reducing the bond purchasing program. Bond tapering, it means that the US Federal Reserve is reducing the purchasing bond program. Okay, so they are buying less bond, injecting less money into the market. This is bond tapering. So last year, November, we entered into this bond tapering program. So this cycle actually started November last year. So it has been ongoing for 6 months, almost 6 months now. 4-5 months now. Okay, so during this cycle, right, if you look at the history, the S&P 500, I'm using S&P is because S&P, like I said, is a very balanced index. So if we look at S&P, we are not sighted toward a single sectors. Okay, it's more of a balance. So I use S&P as a benchmark. So during this cycle, right, S&P actually went up 13%. Okay, that's why a lot of people, when they don't understand the economic cycle, they will keep telling you the market is going to crash, the market is very bad, etc., because they don't understand what cycle are we in now. So people that talk about bear market last year is people that they don't understand the cycle, because if you look at the history, bond tapering is still a bullish cycle. You know, as you can see, it's still a bullish cycle, which is why you can see that from last year November, early November or October, until December, the market is very bull. You see, the market is still very bull because we are in this cycle. Now, after the first cycle, right, we move into the second cycle. Okay, the second cycle we call the recession cycle. Okay, as you can see, recession cycle, actually the indexes has is lack of momentum. Okay, US indexes do not have that bullishness anymore, as you can see. But there is no bullishness doesn't mean the market is going to crash. You know, the market is not going to crash unless it's a major recession. Because back in 2014 November until December 2016, there are 14 months. If you look at, you can just Google up the minor recession, the recession in 2015. Is there a recession in 2015? Yes, there is. It all started from China. Okay, China started the recession, then burn it down to US. Okay, which is why you can see the indexes, there is no momentum. The S&P 500 stagnant. You just don't see US indexes breaking new high anymore. Okay, stagnant doesn't mean there is no opportunity. It's just that you need to know what cycle are we in now. You need to know what kind of trading strategy you need to apply. So if you know we are in recession, then you know the market can still move. It's just that you need to do a consolidation trade. You don't put big hopes of a bullish trade, like very big bull kind of, like you just want to hold everything, etc., etc. You don't do this kind of trade. You do it as in buy low, sell high, buy low, sell high. You just keep repeat the same trading strategy, because we know that during the recession, the S&P 500 is going to be stagnant. Okay, this is the second cycle. Now we move into the third cycle. Okay, the third cycle we call the interest rate hike cycle. Okay, so back in 2015, right, the Federal Reserve, the US, they raised the interest rate from December 2015 until December 2013. So 15, 16, 17, 18. As you can see, 3 years. It took the Federal Reserve 3 years to raise the rate from 0.25% to 2.5%. It took them 3 years. And you can see during the interest rate hike cycle, right, the indexes are actually extremely bullish. Okay, it's only at the early stage that the indexes doesn't perform. This is a monthly chart. So the first month, the second month, the third month, and the fourth month, the market starts to recover, to sideways, and resume the bullishness on the 6th month. As you can see, so a lot of people are saying that interest rate hike is very, they are just worried about interest rate hike, saying that this interest rate hike might kill the equities market, etc., etc. But if you understand the cycle, you look at the history, actually interest rate hike, there is no worries about interest rate hike, because the first 6 months might be stagnant. Okay, the S&P dropped 13.5% when the Fed just announced it, or when there are rumors saying that the Fed is going to increase. But subsequently, look at what happened subsequently. The S&P 500 went up 40%. Okay, so if you are just very worried, you just miss the whole bull run after the interest rate hike. So interest rate is not very scary. Okay, so understand what is our current economic cycle actually do helps you to prepare your trade, whether you should be positioned in the equities market or you should stay out of the equities market. Now the final cycle we call the quantitative tightening cycle. So what is quantitative tightening? Just now we talked about bond tapering. Okay, so bond tapering means the Fed reduce the purchase of the bond. Okay, they reduce, but they are still buying. Okay, they just reduce. Now quantitative tightening means the Fed try to resell all the bond that they purchased back to the corporates. So the corporates needs to buy back everything that they issue, the bond that they issue and the government purchase. Okay, so the corporates needs to buy back everything. So when corporates buy back the bond, they use their cash to buy back the bond from the government. They have less money for dividend payout. They have less money from share buyback. as if you have been looking at US equities market for a while, right, you should know that a lot of people, they say that US market, why can US market keeps going up? Because there are a lot of share buyback programs. If you look at all the index linked stocks, the big cap, they share buyback a lot, you know, they just keep share buyback, and the share price just keep going up. Okay, so when the companies use the cash to buy back the bond, right, there are less money for them to do the share buyback, for dividend payout, etc., etc. Hence, there are less liquidity in the market. Okay, which is why, as you can see, under the quantitative tightening cycle, the US indexes stagnant as well. The S&P 500 actually stagnant in this cycle. Okay, there are less momentum and might even have some major correction. As you can see, tightening stage is more volatile. Okay, the high and low is bigger, the range is bigger. Okay, so now back to the question, what is the current economic cycle? Where are we now in the US indexes? Okay, before we look at where are we, let's look at what does the Fed say in the latest FOMC meeting, okay, back in 16 March 2022. So the first one is US said that they are starting to raise the interest rate from 0.25 to 0.5. So we are definitely in the interest rate hike cycle right now, because the Fed suggests that they will try to hike it on every FOMC meeting moving forward, and there are even chances that they will increase by 0.5% one go. Okay, so we are definitely in this cycle. Now, what is the other one? If this news is dated 17 March, okay, it's after the FOMC meeting, on the 16th of March. If you look at the news, right, under the Reuters, the Fed actually suggests that they are going to explore to start the quantitative tightening in the upcoming FOMC meeting. Okay, you see, the Fed say on Wednesday, it expects to begin the so-called quantitative tightening, which is a reduction of its nearly 9 trillion balance sheet. This means US wants to sell back the bond to pay down their debts. Okay, so we are definitely looking into the quantitative tightening era, probably after the next FOMC meeting, okay, which is in May. Okay, we are definitely looking at this cycle after the next FOMC meeting. We just need to look at what does the Fed say. Okay, so now what is the current economic cycle? So we are definitely at this moment, we are definitely inside this second or third. Okay, in between probably. Okay, somewhere in between, but definitely interest rate cycle, like I said, the bullish momentum is still definitely going to be there. But once US Federal Reserve officially announced the quantitative tightening cycle to start, then probably we need to be a bit more conservative, which is May. Okay, the Fed does suggest that they are going to explore the quantitative tightening. Okay, they are going to explore, which is on the 4th of May. So in my opinion, we are still here, between here and here, probably not recession yet. Okay, because what is recession? Recession means that the GDP is not growing. Okay, the GDP is not growing. Why is the GDP not growing? Because your salary, the growth on your salary is not as fast as the prices of the goods going up. Hence a recession, because your buying power just reduced. But at this moment, yes, obviously our buying power reduced. Probably, I believe the buying power of US citizens reduced as well. But we are not seeing a reduction on the GDP yet. So definitely we are not in this cycle yet. But I don't deny the possibility. Okay, but definitely not at this moment. Not at this moment. We are definitely inside here now. So just don't be too afraid at this moment, because I believe market is still going to go up. Okay, still going to be going up until we see a confirmation or more confirmation about saying that, okay, the Fed is going to start this quantitative tightening cycle. Although they say they might start in May, but it's not like a confirm yet. Okay, they might not. Okay, so before we see it happen, we just think that we are in this cycle. Okay, we are still in this bullish momentum cycle. Okay, So yeah, that is our current economic cycle. So after we look at the current economic cycle, right, let's look at how does the Ukraine-Russia tension affect the US indexes, and what are the things that I personally look at as an indicator to monitor all the development of the war, of the Ukraine-Russia tension. Okay, first of all, we want to watch out all the key levels, because all these candlesticks really mean something. Okay, because these candlesticks are the candlesticks that happen when the news hit the market. So the first one is, it happens on the 11th of February. Okay, so the US president, he warned all US citizens in Ukraine to leave Ukraine. Okay, because he said Ukraine and Russia is going to have a war on the 16th of February. Okay, which is like 1 week later, a war is going to happen. So US president actually says something like that. So the US indexes actually drops. And this is the law. Okay, this is the first law. We need to monitor the key level, which is the law of when the incident happened. Now, what happened after this? On the 24th of February, okay, US citizens, not US citizens, Putin, the Russia president, he announced a full invasion on Ukraine. So Russia president actually put the words out saying that, okay, effective today, we are going to attack the Ukraine. So because of that, US indexes actually plunged quite a fair bit after the news, but recovered. So we just need to pay very close attention to the law. Okay, just the law. We just need to look at the law. This is the second incident. The rest are meaningless. We just look at the law. Okay, now on the 28th of February, Biden actually urged all the European and to ban Russian. Okay, and Biden actually implement to limit Russia on the SWIFT banking system. You see, this is something really major. How major is it? Basically, US President Biden, once he banned this SWIFT banking system, nobody can transfer money in or out from Russia. Is that very serious? But if you look at it, right, how serious it is, it still doesn't break the law of the previous incident. So you can see, although the incident sounds very crazy, very serious, but you see, it just doesn't break new law anymore. Okay, as you can see, it just doesn't break new law anymore. So no matter how serious it is, probably the market players, the traders, the investors, think that probably is not going to be as bad as it is, since it doesn't break new law. Now, the next incident on the 8th of March, the US president announced a ban on import of Russian oil. So so US saying that they are not buying the Russian oil. Okay, regardless the oil shortage, etc., they are just not buying. So even if you look at the incident, right, the day itself or the day after the incident, for the next 3 days, a new law is just doesn't happen. You know, we are not seeing new law anymore. You see, so basically this is the worst. So we just, since we know this is the worst already, you see the law, this is the worst already, we just pay very close attention to this key level, 4140 to 4120 or 4140, somewhere here. Okay, 4100, you can just take a round figure, 4100. As long as the indexes is trading above it, I believe the war is not really impacting the US indexes anymore. This is the first way how I monitor the key levels, okay, from the development of the war versus the indexes. Now, the second thing that I personally look at is looking at the currency. Okay, I'm looking at the currency. If you look at USD versus ruble, Russian ruble, right? This is the Russian currency. Okay, if you look at it, right, when the war started, the Russian currency just weakened from 80. Suppose you can buy $1 USD with 80 ruble, but now after the war you need 150 ruble to buy $1 USD. You see, weakened by 100%. That is crazy for a currency to weaken by 100% versus the US dollar. Okay, so now as you can see, it started to stabilize a little bit already, and it's going to move within the range of the low at 95 and the high of 110. So as long as the currency, the ruble, right, it doesn't continue to weaken. So weaken meaning it goes above. Okay, meaning you need more ruble to buy $1 of USD. As long as the Russian currency doesn't weaken anymore, the war is going to slowly ease up. Okay, but if you see US dollar weaken means if ruble Russian dollar strengthen, right? Okay, strengthen meaning it drops below the 95, meaning to say the tension is probably going to end very soon. Okay, it's easing already. Okay, so just monitor the currency, because why currency plays such an important role. As you know, US banned the SWIFT banking system. So if nobody is buying Russian goods, nobody is using Russian currency to trade, definitely the currency is going to get very weak. But if Russian currency getting stronger, meaning to say there are buyers, there are people that actually really buy into the Russian currency. So probably it means that there are people starting to buy Russian products already. Okay, currency is the most direct things that we can look at to monitor the entire incident. Okay, this is just my own point of view. Okay, so this is what I personally am looking at. Now let's look at the third one. Have US indexes bottom out? Okay, now we need to look at a few things. Okay, these are just some of the key things or the summary that I think is quite good, easy for us as a retail investors to look at. We have all the access to this information as well. Okay, we have all the access, so it's very easy to look at. The first one, we look at the long and the short-term bond yield. Okay, just for your information, if you are not our client, or if you are our client and you are not aware, at Phillip Futures, we do offer long and short-term treasury yield, the bond yield. Okay, so 2 years, 10 years, 5 years, 30 years. If you want to look at the live price, you can always check with us. We have all the micro contracts that you can activate and look at the live bond yield prices. Okay, we have the long-term, the short-term, everything is in our platform. The second one, we're talking about the volatility index. Okay, just pay close attention to the volatility index. The volatility index is going to give us some very crucial information about the market moving forward. Okay, again, Phillip Futures, we do have live price feed because we allow our clients to trade the volatility index. Okay, so if you want to look at the live price feed of the volatility index, you can also check with us. Okay, you can have live price feed in your account. And the last one, again, we relook into the history. Okay, probably it's just some repeating, but yeah, it's always important to look into how historically US indexes perform against every incident. Okay, so first one, let's look at how does the US long and short-term bond yield tell us. What information does the bond yield tell us? Okay, so if you look at this, right, the blue line, okay, the dark blue line, this is the 10 years treasury yield. The orange line is the 5 years treasury yield, and the light blue line is the 2 years. So 2 years, I will call it as a very short term, and 10 years, I put it as a long term. Okay, so if you look at back in 1995 to 2001, this is the dot-com bubble or recession. Okay, this is the dot-com bubble. So if you look at the dot-com bubble, basically, you see all the lines are moving together. As you can see, they go up and they move really, really closely, which means that what does a very close moving bond yield means? It means that the prices in between the long and short term are all the same. Okay, I will put this into a layman term for you. For example, if today you walk into a bank, you tell the teller that you want to place fixed deposit, and the bank tell you that you want to put 2 years or 5 years, and the rate are the same, are totally the same, or probably even lesser for 5 years. if you get lesser interest for 5 years, do you want to put your money in the bank for 5 years, or you prefer just 2 years? Is it even making sense for you to place your fixed deposit with the bank for 5 years if you get lesser return? It's not making sense, right? Same as the bond market, the bond yield market. It's not making sense at all. Means something is wrong in the economy. Okay, something is wrong in the economy. This is the concept. So if you look at when the bond yields just move very closely or invert, right, it means that some part is probably wrong in the economy, which is why we have this the dot-com bubble. You see that you actually move really closely. Okay, now move on to the next one. You see, after the crash, right, after the economic crisis, basically the yield move away from each other, as you can see, and then back in 2006, the whole thing comes together again. Actually, 2005 it starts to come together. As you can see, the narrow, the short and long term just narrow again. And you can see after the whole thing narrow, we have a subprime mortgage crisis, or we call the Great Recession. Okay, we call the Great Recession. So after the recession, basically the bond yield start to widen again. It widen up again, wide until the COVID. You see, until the COVID. So market crash again. You see, it actually moved really nearly. You see, as you can see, after the market crash, the whole thing widened again. As you can see here, the short and long term, that is why back in 2020, 2021, people are just worried about that. Oh, economy is bad. But if you look at the long and short term bond yield, is actually very healthy, very bullish for the market. Okay, very healthy, very bullish for the market. As you can see, all this, the wider the gap, right, the more bullish the market is going to get. You know, just look at the bond yield. It tells you very, very important information. So now, if you look at it again, the long and short-term yield are actually moving together again, as you can see. But moving together doesn't mean market is going to crash right now. Because if you look at this, right, it actually can move together for quite some time. You know, can move together for 6 months, for 12 months, before a very big correction. So just don't be afraid. Remember the things that I told you. Look into the history. How does each economic cycle actually perform against everything? And where are we now? Look at where are we now. So if you look at it, market probably is still going to be bull. At this moment, I'm just talking about this moment. I'm not talking about very far away. Just this moment. Why? Because this thing haven't even consolidated, you see. If you look at the past, right, it always consolidate first. It consolidate first. We are not even seeing the consolidation. Okay, now, so I put S&P 500 into the picture for you to have a clearer view. How does the S&P perform when the long and short-term yield actually invert or move together? Okay, if you look at this chart, right, you just remember the chart pattern now, because I removed some lines for you to have a clearer view. I only leave one line, which is the 2 years treasury yield. Okay, but if you look at this tree pattern, right, just remember the pattern. It's actually just here. Okay, I removed the other 2 lines, so it's not messy, easy for you to look at. So if you look at here, right, the consolidation, the dot-com bubble, the S&P actually the correction don't happen just when all the lines move together, or the short and long-term yield are moving together. It doesn't just crash like that. It actually correct 80%, 8 months after the yield curve actually invert, starting the date that the yield curve invert. So invert, I will just tag. So after the 8 months, okay, now let's look at the second incident, which is the 2006 subprime mortgage crisis. The indexes actually correct 90%, 16 months after the yield curve invert. So if just because the yield curve moved together and you just completely 100% stay out from the market, probably you might miss some bull run, you might miss some opportunities that you can do consolidation trade, like I mentioned, as long as you know where are we now. You see, so The second one, it actually corrects 16 months after the curve invert. Now, back in the COVID, okay, look at the COVID. So this is the COVID the yellow, the orange line is actually the S&P, right? Okay, so S&P actually correct 25% 13 months after the new curve invert. So we are only at the early stage of the inverted U curve. Okay, the whole U curve just inverted in March. Okay, just started when US actually announced the interest rate hike. So the whole thing just started. So don't just be very afraid. Just understand which stage are we in now, and whether how much capital, what kind of risk management that you need to do. You know, since we know that a recession probably is coming, you know, and also probably the U curve is going to really invert. We know all of this, but whether is the market really crushing right now at this moment, the answer is definitely no. If you ask me, the answer is no, as all the data that I just presented. Okay, so this is the first thing that we look at, the long and short-term U curve. Now let's look at the second things, the VIX, the volatility index. Okay, if we look at the volatility index, right, back in 2020, so this is a consolidation. You see a consolidation. So when the volatility break above it, right, it means that US indexes are more bearish. Okay, and a lot of people, right, they say 2021 is actually a very bull year. Why is 2021 such a bull year? Because the volatility, if you look at the volatility index, you know, because the volatility index actually break below the COVID breakout. You see, it breaks below the COVID breakout. So if it breaks below the COVID breakout, it means that the market is actually quite bullish. You know, it means that the market participants, the traders, the investors think that the market is quite bullish. That is why there is less worry in the market. You see, but right now, if you look at what happens right now in 2022, the volatility index actually break above it. That's why you can see that the indexes are less performing as compared to 2021, are not as performing. Okay, so whether this, just keep an eye on the volatility index, it will tell you some information. If this thing breaks below the low again, then probably we will see some bull market again. Okay, just pay close attention to the volatility index. So, okay, so I got this price feed from our platforms, okay, for our platforms. So what does the VIX prices on different contract month tell us? So as you can see from this chart, the higher the VIX, okay, the higher the VIX, the weaker the equities market is. The lower the VIX, the more bullish the equities market is going to be. Now, if you look at this one, futures, why futures? What are the beauties of futures is that we have contract months. So different contract months traded with different prices, telling you what are the sentiment of the market when it is in August, when it is in September, you know, when it is in July. What are the market expectation when we move into July, we move into August, we move into September? If you look at the prices, traded prices, right, as you can see, the further demand, the higher the volatility index. So just now I show you, what does a high volatility index means? A higher volatility index means that the market are less bullish towards the equities market as we move forward the year. Okay, so as we move into June, July, August, September, October, the market is actually getting more and more bearish over it. Okay, it's actually getting more and more bearish over it. So if you look at it, the VIX 5-month contract prices are higher than the near-month contract prices, indicate that the market participants are expecting US indexes to be more bearish as we move into the Q3. So September is Q3. As you can see, the VIX is trading at the highest level. So if you look at VIX, right, back in 2021, if you look at VIX back in 2021, the further demand, the smaller the figure. I'm telling you this because I'm monitoring the VIX back in 2021. So the further demand, the smaller the figure. the nearer the month, the higher the figure, which means the market participants do expect bull market in 2021. That's why I keep saying that the market is going to be bull in 2021, but there are a lot of people using the whatever index are there, is this Warren Buffett index, this and that, saying that the market is going to be bad and stuff. But if you look at the history, all the indicators is actually a bull market, but not this round, yeah, not this round, because the VIX actually tells us something different already. Okay, the VIX actually tells us something different already. Okay, so this is the second thing that we can use to monitor the market. Now, the last thing, how does S&P 500 perform in the previous quantitative tightening era? Okay, so as I said, move into May and forward, we are expecting the Federal Reserve to announce quantitative tightening, because there are rumors saying that they are going to start this quantitative tightening. So it's very likely that we will move into this stage at the second half of the year. So for now, until the second half, probably we are still experiencing a bull market, but we will move into a stagnant market or a correction kind of market. Okay, so as long as but there's a difference. There's a difference between in the past and right now. It's something that probably you can think about it yourself. So in the past, right? In the past, the Federal Reserve started the quantitative tightening 3 years after the interest rate hike in 2018. Okay, so it started the interest rate hike in 2015, and the quantitative tightening only started 3 years after it. But right now, at this moment, the Federal Reserve is actually expecting to start the quantitative tightening in May. Like the news that I shared with you earlier, the Fed is actually exploring to start quantitative tightening in May. Okay, so if it is not happening, the next FOMC probably is happening in the next FOMC. So it's definitely happening very soon. Okay, in the next 3 to 6 months, definitely happening. So right now, they just increased the interest rate this month, and they are already exploring the quantitative tightening stage already. So they are doing interest rate hike and tightening together. So how will the market really react with the lack of liquidity? This is something we don't know yet. But definitely, if you ask me, tightening stage, definitely I am preparing for this kind of consolidation trade with less bullish view, be more conservative with the trade, at least but there are still bull opportunity inside. Okay, it's just that be more conservative, because we are moving into this final cycle very soon. So after this final cycle, we know the market is going to resume its uptrend, the bull market. Okay, so this final cycle can be an opportunity for you to reposition into the market, to pay close attention, because things are happening. The timing that it happens this round and previous round slightly different. So yeah, we won't know what is happening, but we can always look at the chart. Okay, we can always look at the chart. Okay, so if we look at the chart, right, this is 2021. Okay, 2021. Some people, they like to scalp. They like to scalp in out, but some people, they like to be more of a position trading kind of trader. So for me personally, I prefer to ride the trend. I prefer to scalp less. Okay, this is just me myself. Okay, so if you look at this chart, right, this is something that I realize has been extremely accurate. Okay, has been extremely accurate. If you look at every correction, right, and if you zoom out a little bit, they always have this reversal signal. They always have this reversal signal. So every correction has a reversal signal. If you look at the latest one, right? If you look at the latest one, okay, since the reversal, this is my way of catching reversal, which is a W. Okay, a W, a lower high, whatever you call it. Okay, so moment it break up the W, right? You enter with the candlestick, and your stop loss, you just place a stop loss below the breakout candlestick. As simple as that. You see a correction. Do you see a W here? No. Do you see a W here? No. Do you see a W here? Yes, you do. So moment it break out the W, you just enter with that candlestick with a stop loss underneath. Okay. Now let's look at the latest one here. This is latest. Okay, March 2022. So correction from here. Do you see a W here? No. Okay. What about here? Is this even a W? Okay. Is this a W? Is it clear enough? If it is no, this is not clear. If you ask me, this is not clear. The W doesn't have enough time to consolidate. If you look at the W here, probably it takes a couple of months, 1 to 2 months to form that W. This is a daily chart, yeah. Okay, 1 to 2 months. It takes 1 to 2 months for you to form that base. This is also 1 to 2 months. Okay, at least 1 month, 1.5 months, something like that. But if you look at this one, this is how many days? 1 week only. So I don't consider this as a W. Okay, but if you look at here, is this a W? Probably, but it didn't break out. You see, this can be, but it didn't break out. So it didn't break out means I do the breakout candle, like I said, I do the breakout candle and I place a stop loss below the breakout candle. Okay, so if you look at here, is this a W? And does the consolidation happen like over a month? You know, a month. I usually take a month, something like that. 3 weeks to a month. It does, and it does look like a W. And breakout, just enter. Even if you enter at the highest, as long as you are happy with the risk, then you are feel free to do a position trade. Okay, especially with CFD. So tonight, I will share a bit more about the CFD, how you can use the CFD indexes, especially the S&P one, to trade this kind of pattern. Okay, I will share a little bit later on. But before that, I just want to do a quick conclusion. Okay, so the first one, the inverted US long and short-term bond yield actually tell us that US indexes might have a major correction within 15 months, because like the statistic that I showed you earlier, after the bond yield, long and short-term bond yield inverted, right, a correction might happen anytime between 6 to 18 months, okay, in between the period. So for this moment, likely going to be bull, but after 6 months, probably we need to be more conservative. Okay, so I don't deny the possibility of a major correction within 15 months. Second, look at the VIS. So the VIS actually suggests that the market participants are actually more bearish on the indexes on the forward month. As you can see, forward month prices are higher than the near month, indicating the market are more bearish over as the time move on. The third one, based on historical performance, okay, the bullish momentum on US indexes tend to be a bit more flattish, means it's not going to be so bull when we are in the quantitative tightening era. So are we entering a quantitative tightening era moving forward? Definitely the answer is yes, we are going into it. Probably the next FOMC, if it is not, then it's the next, probably after the next one, after the May FOMC. You see, so we are definitely going into it. So be more conservative after we officially enter this quantitative tightening era. Okay, and the last one, based on technical analysis, right? US indexes correction due to, which means, as we all know, the whole indexes collapse. People say it's due to the war. Okay, so is the war over? If you ask me, you look at all the law, the critical, the date of every economic events that happen. If you look at the law, it's definitely over. Okay, and even if you look at the currency of Russian currency, the ruble, is consolidating. So as long as US dollar weakens over it, then likely we are going to see a short-term recovery. Okay, so US indexes, in my opinion, is going to recover until the next FOMC, which is in May. So don't be afraid to participate when we all know that the market is going to be bull. You might just miss out some opportunity. Okay, and this bull is going to be short-lived, but we know our time frame. Okay, it's going to be short-lived, but it's going to. Okay, now just want to do a very quick one to let you guys know that this is something that I think is a very amazing product, especially if you want to trade the S&P indexes, doing a swing trade on the S&P indexes. Why? First of all, the brokerage is very affordable. It's only USD2 per contract, okay? And the whole promotion actually runs from March, which already started, right, until September. Brokerage is low. And if you look at, this is the contract spec for the US index CFD. Okay, I will just focus on the S&P today. Okay, we have Nasdaq, we have Nasdaq, margin is 700 USD. We have Dow Jones, margin is a bit higher, but the main one is the S&P 500 because the margin is very low. It's only 220 USD. Okay, and 1 point is equivalent to USD $1. Okay, if you look at it, right, I go back to my chart. If you look at this chart, right, if you want to do position trade, let's say you enter at the peak of the chart, is how much? 4350. Okay, 4350. And the cut loss point is where? It's somewhere here, 4250. Remember what I told you just now. Margin 220 USD, stop loss 100 USD. But if you get it right, you might write a very big trend. If you look at here, if you look at it, you enter here, okay, you cut loss here, your losses is less than 100 USD, your margin is 220 USD, and you can get such a big reward. A very good risk to reward ratio if you trade the S&P 500 CFD. Okay, same goes to here. Even if you cut loss here, right, don't be afraid to re-enter the market. Okay, don't be afraid, because it's easy for you to, even for new traders that they are not familiar with US indexes and want to trade the US indexes CFD, margin is low. It's only less than 1,000 ringgit, and you can really ride the trend with this product. Okay, if you want to know more about this particular product, you can probably drop us a message in the comment box. We can let you know more about it. Okay, and also if you but there are some requirements to open a CFD account. If you want to know the CFD accounts requirement, you can ask us about it. Or else, if you are already our futures client, or these are the futures contract spec. Okay, if you want to know more about how each contract, because the margin is not high as well, just the S&P 1254, so it's about 5,000 ringgit Malaysia. Okay, and 1 point is slightly bigger, it's USD 5. So the CFD 1 point is USD $1. So there are differences. If you really want to know the differences, you can always talk to us. Okay, you can talk to us and we can do a summary for you to let you know more about it. Okay, so now go to the Q&A section. But again, just to let you know, if you want to open an account, you can always scan this QR code. Now, let's move on to the Q&A section. If you have any questions, you can type in the Q&A section, and I will try to answer some questions. Okay. So first question by Azi. The third cycle showed that the interest rate hike took 3 years, but this time Fed expected to increase drastically. Does that cycle still applicable in the current situation? Okay, like I said, previously it took 3 years for Fed to increase the interest rate. Okay, but this round, the Fed, previously it took 3 years before we moved into the quantitative tightening. Okay, that is why the market is really bull back then. But right now, the interest rate hike era before the QT, which is the tightening era, is only a few months. So in between these few months, I reckon the market is going to be bull. Okay, before the QT era, right before the QT era, in my opinion, is going to be bull. So before QT, I'll just ride the bull. Okay, I hope this answers your question. Now, the second question is also by Azi. Does the current situation still similar to previous tightening? Because it seems like the current hike is not sufficient to control the high inflation. Okay, how will the inflation turns out after the tightening? I think nobody knows. Probably even if today you ask the Federal Reserve, they won't know as well. They are only hope only. They only hope it can contain. But definitely, if inflation is not containable, we are definitely going to enter into a recession. Recession is definitely going to calm the inflation down. This is guaranteed, because what is recession? Which means people do not have that buying power anymore. So it's always about go back to supply and demand. If people are not buying anymore, means the prices going to drop because the demand just disappeared. So when the prices drop, the inflation drops. So if the Federal Reserve can't contain the inflation with the tightening, then probably we are going to look into the recession era, like what I have shared. So what happened in recession era? Look back into the past. What happens to the recession era? Does recession era comes with a market crash, or does recession era comes with a stagnant market? Then you will know what kind of strategy you need to apply. Okay, next question here. Where to find the long and short-term bond yield in the platform? E5Lock. Are you our client? I'm not sure whether E5Lock is our client or not. If you are our client, you can contact your dealer. They can help you to activate the bond yield price feed in your account for you to look at if you want to look at. I'm not sure whether you are our client. If you are not our client, you want to open an account, you can contact us. Okay. Okay. Next question by Sam. How long is the QT will last normally? Is the index moving out after the QT end? Okay, this is a very good question. Like I said, how long we won't know, because Fed is definitely going to finish everything very fast this round. If you ask me, it's definitely. But after the QT, definitely, in my opinion, market is going to resume. Okay, so QT is actually a very good opportunity for investors to buy the dip if we really see some correction in the tightening era, because after tightening means that the market will resume. Okay, so cycle just keep repeat itself all the time, every 7 to 10 years. So since US, if you look at it, right, since US actually start to increase the interest rate to a peak until now, it has been many years. It has been many years. Okay, so the whole thing is going to just keep repeat itself. If you can understand the cycle of every economy, what kind of product is going, what commodities will move, what indexes will move, under what cycle, you will just do well in the financial market. Okay, next question here. What will happen to the inverted yield curve after it drops and expands? Also by Sam. I think I shared this earlier. So when the inverted yield curve, after it drops, when the thing expand, means widen up, market back into the bull run. Okay, so as long as you see that yield curve widens up, just don't be afraid to trade the market. Even when the noises in the market tells you that market is bad, economy is bad, but just don't be afraid, because the yield curve is the most direct answer. It's widening, it's widening means that there are lots of money, lots of liquidity in the market to push all the prices. Just don't be afraid. Don't look at all the statistic data, economic data, that frightens you. Okay, that is just my opinion. Some of the indicators that I personally look at. Okay, so also another question, just one last question. For CFD trading, if we hold a long position, will we be charged interest? Yes, there are interest charges on CFD, but futures, no interest on futures, but CFD, yes. If you want to know how all the CFD works, you can ask us about it. Okay, you can contact us to ask us about it. So basically that is all the questions. There are all the questions. So yeah, I guess that is all about tonight's event. And also just to let you know before I finish, these are the social media of Phillip Futures. If you want to know some latest updates, latest promotion that we are doing, you can follow us. We usually updates all our promotion, a bit of the market news on our social media. And also, if you want to contact us, these are our contacts. Me, myself, I'm from Cochin branch. So yeah, if you want to talk to me, you can contact Cochin branch as well, or you can just contact your respective dealer to ask about their opinion. Okay. So basically, that is all for tonight's event. And yeah, thank you all for joining me. And yeah, Bye bye.